Ever wondered why the US dollar remains so powerful? Or how a single commodity can dictate global financial policies? What if I told you that the stability of the global economy hinges on a single agreement made nearly 50 years ago? When the US and Saudi Arabia struck a deal to trade oil exclusively in US dollars, it wasn't just about oil, it was about cementing the dollar as the world's dominant currency. This agreement has not only influenced international trade, but has also ensured a constant demand for US dollars, making up nearly 60% of global foreign exchange reserves. Welcome viewers to Satoshi Finance, where we navigate the complexities of the financial world to empower you on your journey to financial freedom. In this video, we'll dive deep into the history, impact, and future of the petrodollar system, unraveling its intricate connections to the global economy. Prepare to be amazed by the hidden mechanics that keep the world's financial systems ticking. The petrodollar system emerged in the early 1970s as a result of an agreement between the United States and Saudi Arabia. This arrangement was initiated after the collapse of the Bretton Woods system in 1971, which had previously pegged the US dollar to gold. With the US dollar no longer backed by gold, there was a need to stabilize the dollar's value and sustain its global dominance. The US reached an agreement with Saudi Arabia in 1974, whereby the kingdom agreed to sell its oil exclusively in US dollars. In exchange, the US provided military protection and economic aid to Saudi Arabia. This agreement was later extended to other members of the Organization of the Petroleum Exporting Countries, OPEC, cementing the petrodollar system. The petrodollar system significantly influenced global economics and trade by ensuring that oil, a crucial global commodity, was traded in dollars. The system reinforced the dollar's status as the world's primary reserve currency. This arrangement facilitated international trade as countries needed to hold large reserves of US dollars to purchase oil. It also created a steady demand for US Treasury securities, as oil exporting nations invested their surplus dollars in American financial markets. The petrodollar system has thus provided the US with significant economic leverage and has played a critical role in maintaining the stability and liquidity of global financial markets. In recent years, Saudi Arabia has signaled its intent to diversify its economic partnerships and reduce its dependency on the US dollar for oil transactions. This shift is part of a broader trend where the kingdom is exploring the possibility of accepting other currencies, such as the euro and the Chinese yuan, for its oil exports. In 2022, there were reports that Saudi Arabia was in discussions with China to settle some oil sales in yuan, marking a significant departure from the petrodollar system established nearly 5 decades ago. This move is seen as part of Saudi Arabia's broader strategy to strengthen economic ties with key Asian markets and reduce its vulnerability to US economic policies and sanctions. And several factors are driving this shift away from the dollar. Geopolitical changes, particularly the strained relations between the US and Saudi Arabia, have played a crucial role. The US's diminishing reliance on Saudi oil due to increased domestic shale production and policy differences on issues such as Iran and human rights have contributed to a cooling of the historically close ties. Additionally, Saudi Arabia's Vision 2030 economic plan aims to diversify its economy away from oil dependency and build stronger partnerships with emerging economies. By accepting other currencies, Saudi Arabia can attract more investment from countries like China, which is already its largest trading partner. This strategic pivot also reflects a global trend towards de-dollarization as countries seek to mitigate the risks associated with the dominance of the US dollar in international trade and finance. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. The potential shift by Saudi Arabia away from the US dollar in oil transactions could have significant short-term effects on the value of the dollar. In the short term, the announcement alone could lead to a decrease in demand for the dollar as global markets react to the news, potentially causing a drop in its value. Investors might anticipate a reduced need for dollar reserves, leading to volatility in currency markets. In the long term, if more countries follow suit and the dollar's role in global oil trade diminishes, the structural demand for dollars could weaken. This would likely result in a gradual depreciation of the dollar, altering its position as the world's primary reserve currency and affecting its exchange rate against other major currencies. The implications for U.S. inflation, interest rates, and overall economic stability are profound. A weaker dollar could lead to higher import prices, contributing to inflationary pressures within the U.S. economy. To combat rising inflation, the Federal Reserve might be compelled to increase interest rates more aggressively, which could slow down economic growth and increase borrowing costs for consumers and businesses. Furthermore, a declining dollar could undermine confidence in U.S. financial markets, potentially leading to reduced foreign investment. Over the long term, these dynamics could challenge the U.S.'s economic stability and its ability to finance deficits and maintain its global economic influence. Saudi Arabia's move away from the U.S. dollar in oil transactions could significantly accelerate the global trend towards de-dollarization. As one of the largest oil producers, Saudi Arabia's decision to accept other currencies for oil sales would set a precedent for other oil-exporting countries, potentially leading them to adopt similar practices. This shift could diminish the dollar's dominance in global trade, particularly in the oil and energy markets, where the petrodollar system has historically reigned supreme. The ripple effect could see a broader range of countries and industries reducing their reliance on the dollar, opting instead for alternative currencies like the euro or yuan to mitigate the risks associated with dollar volatility and U.S. economic policies. The impact on global trade, especially in oil and energy markets, would be profound. Oil transactions constitute a significant portion of global trade, and pricing oil in currencies other than the dollar would disrupt established trading practices. This could lead to more volatile currency markets, as countries adjust to new currency dynamics. Additionally, countries that currently hold large dollar reserves to facilitate oil trade may diversify their holdings, impacting demand for U.S. Treasury securities and potentially increasing yields. Such developments could lead to a shift in global economic power, enhancing the roles of other major currencies. The euro and yuan, in particular, could gain prominence as alternatives to the dollar. The yuan's increased use in global trade would bolster China's economic influence, aligning with its strategic goals of internationalizing its currency and reducing dependency on the US dollar. Similarly, the euro could see greater adoption, strengthening the European Union's position in global finance. Overall, this transition could lead to a more multipolar currency system, reshaping the global economic landscape and redistributing economic power more evenly across different regions. Changes in the petrodollar system could significantly impact investors holding US dollars and dollar-denominated assets. If the demand for the US dollar decreases due to the diversification of currencies used in oil transactions, the value of the dollar could decline. This depreciation would reduce the purchasing power of dollar-denominated assets and potentially lead to lower returns for investors. Additionally, as countries diversify away from the dollar, U.S. Treasury securities might experience reduced demand, resulting in higher yields but lower prices for these bonds. For investors, this scenario means that the traditionally safe investments in U.S. dollar assets might become more volatile and less attractive. To hedge against these changes, investors might consider diversifying their portfolios to include assets denominated in other major currencies, such as the euro, yuan, or yen. Investing in commodities like gold, which traditionally hold value against currency depreciation, could provide a safeguard against a weakening dollar. Additionally, expanding investments into emerging markets or global funds could offer exposure to regions less impacted by dollar fluctuations. Alternative investments, such as real estate or infrastructure projects in non-dollar denominated economies, could also provide a hedge. By adopting a more globally diversified investment strategy, investors can mitigate the risks associated with shifts in the petrodollar system and maintain stable returns. Saudi Arabia's move away from the US dollar in oil transactions could precipitate significant geopolitical shifts. Traditionally, the petrodollar system has been a cornerstone of the US-Saudi relationship, underpinning broader US influence in the Middle East. By diversifying its currency basket for oil sales, Saudi Arabia signals a desire for greater economic independence and stronger ties with emerging powers like China and the European Union. This shift could reduce US leverage in the region, potentially altering alliances and power dynamics. It may also prompt other oil-exporting countries to follow suit, thereby diminishing the overall geopolitical influence that the US has enjoyed through its control over global financial systems and markets. Other countries are likely to respond strategically to these developments. China, for instance, might accelerate its efforts to internationalize the yuan, seeking to position it as a major global currency alternative to the dollar. The European Union could also seize the opportunity to promote the euro in international trade, thereby strengthening its global economic position. Russia, which has been actively pursuing de-dollarization due to Western sanctions, might further diversify its trade away from the dollar. This could lead to a multipolar currency system where no single currency dominates, fostering a more balanced distribution of economic power. However, this transition could also heighten global economic competition and increase financial market volatility as countries adjust to the new dynamics. The broader geopolitical landscape would become more complex, with shifting alliances and new economic partnerships reshaping the global order. BRICS, an acronym for Brazil, Russia, India, China, and South Africa, represents a coalition of major emerging economies with significant global economic clout. Together, these countries account for about 40% of the world's population and nearly a quarter of global GDP. Formed to enhance cooperation and foster mutual economic growth, BRICS nations have been increasingly vocal about reducing their dependence on the US dollar for international trade and financial transactions. The economic significance of BRICS lies not only in their substantial market size, but also in their collective influence on global trade patterns and financial stability. In recent years, BRICS countries have actively explored alternatives to the US dollar to enhance their economic sovereignty. This includes promoting the use of their national currencies in bilateral trade and financial agreements. For instance, Russia and China have been trading in rubles and yuan respectively to bypass the dollar. Additionally, BRICS nations have discussed creating a new reserve currency, potentially backed by a basket of their own currencies, to provide a more stable and diversified alternative to the dollar. These efforts are driven by the desire to mitigate the risks associated with dollar volatility and U.S. economic policies, which can have outsized impacts on their economies. Saudi Arabia's shift away from the dollar aligns with the BRICS de-dollarization strategies and could accelerate these efforts. As a leading oil exporter, Saudi Arabia's willingness to accept other currencies for oil sales can provide a significant boost to the use of non-dollar currencies in global trade. This move could pave the way for enhanced economic collaboration between Saudi Arabia and BRICS nations, further diminishing the dollar's dominance. Potential collaborations could include bilateral trade agreements, investments in joint infrastructure projects, and coordinated financial strategies to promote currency diversification. Such alliances could have profound implications for global economic dynamics. A stronger economic bloc comprising BRICS nations and Saudi Arabia could challenge the traditional Western-dominated financial systems and create a more multipolar world economy. This shift could lead to increased competition among global currencies, fostering a more balanced and potentially more resilient international financial system. As these countries deepen their economic ties, they could collectively influence global trade policies, investment flows, and financial regulations, thereby reshaping the future of global economics. In conclusion, the potential shift by Saudi Arabia away from the US dollar in oil transactions represents a pivotal moment with far-reaching implications for global economics, geopolitics, and financial markets. The long-standing petrodollar system, which has bolstered the dollar's status as the world's primary reserve currency, may face challenges as more countries and economic blocs like BRICS explore alternatives. This shift could accelerate the trend of de-dollarization, leading to a more diversified global currency system where other major currencies such as the euro, yuan, and possibly a new reserve currency from BRICS gain prominence. The impact on investors holding US dollars and dollar-denominated assets could be significant, potentially leading to currency volatility, changes in asset valuations, and adjustments in global investment strategies. Geopolitically, Saudi Arabia's move could reshape alliances and power dynamics, creating opportunities for new economic partnerships and strategic alignments. It underscores the evolving nature of global economic leadership and the influence of emerging markets in shaping the future of finance. As these developments unfold, it's crucial for viewers to stay informed about ongoing changes and their potential impacts on global economic stability. Understanding the implications of de-dollarization and shifts in global currency dynamics can empower individuals and businesses to adapt their financial strategies accordingly. Whether you're an investor, economist, or simply interested in global affairs, keeping a watchful eye on these developments will be essential in navigating the complexities of a changing global economic landscape. If you found this video helpful, don't forget to give it a thumbs up. Subscribe to our channel for more insightful content and hit that notification bell so you never miss an update. Thanks again for watching, and I'll catch you in the next video.